Hello traders, Gary Wagner here. Approximately 12 noon in Honolulu. Makes it 5 o'clock in New York City. Third day of February 2012. And this is the daily report for gold and silver, our weekend review. We do have the metals under pressure today substantially. We have gold off about $32, $17.26. We have silver off about 70 cents at $33.67. On today's report, we will talk about what has been on everybody's mind since we had this sell-off today, and that is, have we started wave 2? Are we going into a minor correction? If we are, where could that possibly lead us to? We'll talk about that as well as review the week in general, all on today's daily report. Traders, I want to start today's show by looking at the long-term view as well as the short-term view in gold. As you can see, we have multiple charts on the screen. They're all of gold, and I want to take them one by one. First of all, I want to take a look at our daily chart as well as our weekly chart, straight candlestick format. We'll look at the Henkin Ashi charts, the average, but because they're lagging charts, they're not really going to give us a ton of information right now. But the dailies and the weeklies, I believe, will. The first thing that you can see on the daily chart, the daily pattern itself after the sell-off is called an engulfing bearish. An engulfing bearish is where you have what's called an outside trading day. In other words, it opens above and closes below it. It completely engulfs it. Now, in order to actually take this type of call, you have to get what's called confirmation. And confirmation on this type of pattern is fairly simple in terms of what we look for. And that is your following day on a daily chart, following week on a weekly chart, would have to be a long red candle that had a lower high and a lower low. It would look something like this. And if in fact we saw this continuation right in here, in terms of candlestick patterns, you would be getting an indication of a reversal in the marketplace. So we're a little bit early, but my sentiment is there is a high probability that we will go into wave 2, so we absolutely want to prepare ourselves for that. Now, here is our weekly chart, straight candlestick format. The candlestick type that we're getting here, realize that on the week it did end up closing lower because of this sell-off today, the $32 lower. This is almost a shooting star. A shooting star would typically need a tail that is a little bit longer than what we're seeing right in here, but you're getting the small body and you're getting a high to the body that is about 2 times the size. It would need to be about 3 times the size, but it is shooting star-like. So it is something that we certainly want to pay attention to. So what does that mean? Well, to do that, we really want to look at our big picture. And on our big picture, this is where we have been plotting our Elliott wave count. As you notice, I'm putting in 2 as a possibility. In other words, we had the end of the correction. That took place at the end of December. The market has been rallying throughout the month of January, beginning of February. We get our first sharp spike. You can see that right here. As I said, off about $32. Now, if in fact we are going to witness a marketplace right now in which this will be wave 1, and now we'll go into wave 2 before going back to wave 3, the question is going to be, how deep could this correction be? Where could it take us to? And most importantly, when would we see a indication that we were at the bottom or conclusion of that correction and be indicative of the market beginning to trade back up? Now, in order to do that, we're simply going to use a daily chart in which we're going to plot a Fibonacci retracement. And let me go ahead and put that up for us, traders. And that's this right here. As you can see, all I have done is simply plotted a Fibonacci retracement. And the retracement that I plotted is from the beginning of this rally, roughly at around 1520. I've got it at 1522 to the top being 1763. So you've got a pretty sizable move when you consider that the market has moved from 1500 to 17, and then on top of that you have another $40, so about a $240 move. Now, you have a 23% retracement level and a 38% retracement level. Those are typically your most likely retracement levels. It can go as deep as 61%, and I can show you back in February of 2010 where it actually did that on a corrective wave 2. Corrective wave 2s can in fact be deep, and they can go up to 61%, but we want to look at each of these, call them bridges or barriers, if in fact we see continuation on Monday, meaning as the market opens up in Australia Monday morning, we want to see how it reacts if it continues to trade lower at various points. And these are going to be the most important points that we can look at. The first pivot point we want to look at is going to be 1706, and the second one is going to be 1671. Now, of course, we do have stops that are sitting below 1700. We'll talk about adjusting those so that if this market does in fact want to correct, we can maximize the profit that we pull out of this trade that we've got on. We're in at 1580 right in here. We want to make sure that we at least capture 2/3 of this market move. I'm very happy with 2/3 of the market move. So even if we got out at 1700 in at 1580, we were able to substantially get a large portion of this move, and that makes me happy. I'm never looking to buy in at the bottom, nor do I believe that we can sell at the top. But traders, this is what is going to be critical, is what is going to happen if the market continues to trade lower. Where is it going to go? Once again, the most important indicator we can have now in candlesticks is going to be on Monday's trading activity. In other words, do we have a market that continues to trade lower? The fundamental news out there, it's not so much the jobs report that has caused, I believe, the pressure, the downside pressure on gold specifically, or the precious metals markets as a whole. What I believe we're witnessing is the fact that if the economy begins to improve, there's not going to be the same pressure for the Fed to actually go ahead and do quantitative easing, and that's what I think you've got this market reacting to. Now realize, one report is not indicative of a market that has reversed, but it could be the first indication of it. Secondly, we still have our scenario going on in the European Union. And the fact that there's been nothing that has really come out of it in a positive way doesn't bode really, really well for that being resolved right now. However, we certainly want to take a look at it, and we certainly want to be aware of these changes as they come in. In terms of the big picture, and that's what I typically look at this chart for, you can see that this is in Heikin Ashi. It is our daily chart. If we look at this and plot this as number one, we have number two. The good news is, the best news that I can offer you is that with wave one in place, once we have confirmation of it, it allows us to do some forward forecast modeling. In other words, we can take a look at what a typical retracement is going to be, and we can plot the following. We can say, okay, this is our wave one. And now when we look at wave two, if it comes down X amount, and if 3 is, say, equal to or 1.23 times that, we can actually begin to plot a good model to where we think we're going to go on this major fifth wave. Traders, I want to spend a little bit of time towards the end of the show, obviously, on our silver outlook. What we are looking at is a series of different silver charts. The first thing I do want to go through is the Heikin Ashi, and this is the reason when you look at them, you can see that they're such lagging indicators. On our weekly chart, we're still fully blown in a bullish uptrend. On a daily chart, you see that even though it's a down day, this daily compares to this daily here. Even though we have a red candle here, it shows up green because it takes the open as the midpoint from yesterday as a comparison. And you can see that we've inflicted much less damage on the downside when we look at gold as compared to silver. Now, simply what I'm going to do is to remove the indicator so we can take a look at a standard candlestick chart. This is our weekly, and then a standard candlestick chart, of course, of our daily. And you can see that although on our weekly we didn't get the same kind of engulfing bullish that we got in gold, it is nonetheless an engulfing bullish. Again, what are we going to look for? Well, you have to get follow through. Follow through is going to be if you see this type of activity. In other words, where the market goes up and you get follow through on the following trading session, meaning you get a red candle on a candlestick chart with a lower high and a lower low. That would be indicative of what's called a engulfing bearish confirmation. Now, where could that market in fact go? To do that, we simply want to do the same thing we did with gold, and we want to plot our Fibonacci retracement. Now, traders, you can see that I've added a basic Fibonacci retracement to this daily chart of spot gold, starting at the low just above $26 to $34.49. It's a little bit above. I will adjust it in a second. And you can see that if in fact we do go into a wave 2, corrective wave 2, we're going to have a couple of initial targets based on 23 and 38% retracement levels, and those levels are 32.53, that's a 23%, and then 31.32. So if in fact we do see some weakness in the market, these are the two areas that we want to take particularly close watch and attention to. My sentiment is that when you look at gold and silver, silver tends to follow gold. It's gold's little brother. However, when there is talk about a revitalization in the economy, then you get the industrial portion of silver kicking in, and that's why you didn't get the kind of move down, I believe, that you saw in gold today, because with the vibrant stock market, the belief is that there's going to be more need for silver. Now, again, we're in at 28 and change. We've got our stops, I believe, at 32.80. And what we will do is on Sunday, as I monitor the markets, which is Monday in Australia, if we see some signs of weakness, I will be putting out special trade alerts to all of the daily viewers, which will tell you to either get out at the market or tighten a stop to a certain area. But we need to see one more day and see if there's confirmation in the market, and if in fact we are going to witness a beginning of wave 2. Listen, wave 2 is something that is going to come sooner or later. It is expected. It is also needed. Because again, what it allows us to do is it allows us to plot, one, and to do some forward modeling, which is great, and two, it allows us to actually take a couple of trades off the table and pull our first profits of 2012, and there's never anything wrong with taking a profit. This has been Gary Wagner, wishing you as always good trading. We will talk to you first part of the week for another daily update and review. Bye-bye.